development. No, it's not. Doing the light is not working. Yeah, it's stimulates.
I'm looking for the link to this presentation.
Settings? No.
It shouldn't be there, no. It shows up as something here. So it's thrown by it. If you go into the Star Trader YouTube thing, can you see it there?
No, it's still waiting. Still waiting. Video. Okay, where's the stream key?
Yeah. Edit.
Okay.
More.
Let's see. Analytics. This one. This is the video itself. I suggest you go live from YouTube directly.
You need to click another one.
It's from their side.
All right, cool. So this is one link you can use. Where shall I email it to?
John. Or group marketing.
Skype for you now.
Okay. John, circulate this thing.
This is YouTube.
Yeah, that's my personal one, but that's the one I can find the fastest.
Okay.
That's it. Circulate it with the rest. You found it? Okay. You can start.
Tell me when to go live. All right. Thank you very much for joining us here. It's a fabulous Monday, Easter Monday. It's a strange day to talk about Silicon Valley Bank, but hey, that's the way it is. I'm currently in Dubai, overlooking Burj Khalifa over there. It's a fabulous place to have this broadcast. Okay, let's get cracking, shall we? So during today, what we're going to be talking about is Silicon Valley Bank. And we're going to be talking about how Silicon Valley Bank fits into the overall economic landscape, because Silicon Valley Bank is a symptom. It's a symptom of other things going on in the economy. So I'd like to just take you through the journey. Before we start, let me just say that Star Trader is now active in markets where 5 out of 8 people live. If we would have spoken about this 12 months ago, then maybe 2 out of 8 people would have lived in markets where we have offices today. But today we've achieved a situation where 5 billion out of 8 billion people live in countries where we have offices today. That's a big change for a little company. And we are not active in the United States, but we're going to be talking about Silicon Valley Bank today, because what's been happening with Silicon Valley Bank is a symptom of things that are really quite profound to the world right now. So where does this fit in? Well, first of all, let's just ask ourselves, is there money in the market? And the answer is yes. We've had 10, 15 years now of printing money. We've had quantitative easing at a level that we've never seen before. The purpose of that quantitative easing has been via banks to get money out into companies, investment into companies so that companies can continue to grow. And we've had recession risks, etc. Consequently, the central banks have held interest rates really low for a long time, which is changing now, definitely. So, okay, so how do these things fit together? Well, the fundamental, when it comes to inflation, the fundamental is incredibly simple. By way of example, we have a quote bottom right here from Milton Friedman from 1970, where ultimately he says that if we print more money, then we increase output, then we have inflation. It's a monetary phenomenon, really simple thing. And yes, we're seeing some of that. And the reason we're seeing that is because the central banks have kept interest rates super low while the QE has happened, the quantitative easing has happened. And what the banks have done is they've used the quantitative easing as security for loans, so that they've been able to provide loans at levels that have never happened before. They've also bought long-term assets at levels that have never happened before. So the money has actually ended up going into housing, into real estate and shares, as opposed to going into investment. Some of it has gone into investment, but the majority of these QE and loan-funded money, most of the money is loans, has gone into real estate and shares. So we've seen over the last 10, 15 years, we've seen real estate and shares have a bit of a sort of growth period. Okay, well, so what? Well, well, banks rely on fractional lending, where they assume that everyone does not want to withdraw their money at the same time. That's the traditional way for banks to operate. Okay, so what's happening now? Well, the thing that's happening now is that a small percentage of the money that's gone into real estate and gone into shares has begun to leak into the things that make up inflation. Consumer price index is measured based on normal household expenditure. So CPI, or inflation, does not include housing bubbles and share price bubbles and things like that. It doesn't include those things. But now what we're seeing is that a small percentage of the money that has gone into housing and gone into shares is now leaking into inflation. Small percentage. And even if that's only a very small percentage that's leaking out, it's still massive from the perspective of inflation. China is an exception. China's been running on very low inflation for a while, but you have the COVID lockdowns and pandemics. You have a whole bunch of special effects in China that we need to consider then. But if you look at London, by way of example, the stated goal there is to have 2% of annual inflation, but in January 10.1, in February 10.4% in 2023, the annual inflation is way over that. And you find it elsewhere as well. Thailand has been running at over 5% inflation, although the stated goal there has been between 1% and 3%. So it's tricky. It's really tricky. Let's move on from there. So in order to tame inflation, the central bank's job is to keep inflation down. So, okay, so let's simply increase the interest rate. Well, it's not that simple, unfortunately. Would that it was so simple. It is complicated because an increase in interest rate primarily hits companies. So the goal was to help companies by having low inflation rates, low interest rates and lots of quantitative easing. But when you raise those central bank interest rates, that rolls into companies, and companies actually are hurt disproportionately much, really badly. So that's tricky. So actually, withdrawing money is not the same as pumping it out. Quantitative easing is not the same as quantitative tightening in reverse. They're not the same. They're very, very different. When you do quantitative easing with lots of low interest rates, you pump out money into housing and into shares. When you then raise that interest rate, you primarily hit companies. So it's actually quite a complicated situation. Okay, so let's shift into the world of banking. Well, the world of banking most recently has been a world where you have a low income and you have very low costs. And if you take the low income and you deduct the very low costs, you end up with some income. That's quite fragile. So the income has been driven by the difference between the amount of money paid for borrowing money. So you have depositors who deposit money, and you pay them a small amount, and then you make money by lending out your money to long-term assets, where you buy bonds, and these long-term assets have a higher interest rate. Consequently, you make money. So the bonds don't give you a lot of money, so that's a low income, and the cost that you pay out to your depositors is very low. So fine, that's where that difference sits. However, when you start increasing the interest rate, that's when it becomes really tricky for banks. So banks are hit really hard because they were already in a fragile position. So let's look at Silicon Valley Bank in particular. And you see, when you start looking at Silicon, that there are quite a few warning signals. We've already gone through the delicacy of Silicon Valley Bank. And we've already said that, okay, there's a fine line there between how much income you can get and what your costs are. In the case of Silicon Valley Bank, back in 2021, Silicon Valley Bank was making about 1.64% annually from its long-term bonds being where they put the money. And they paid out very low interest rates to their depositors. So very tight, and that's how it worked. And the CFO, Chief Financial Officer Daniel Brock, he went out in early 2021 and acknowledged that there's a sensitivity here because if the central bank interest rates go up, then there's going to be a problem. And he assured the markets that indeed everything is under perfect control. We don't need to worry. We've got this covered. Lovely. Okay, so on the right-hand side of this picture, you see Silicon Valley Bank's long duration bonds at 1.64%, and a small part thereof are things that are AFS. They're called assets for sale, AFS, and consequently, they are things that can be sold if need be. And these AFS are very much needed because if you do get increases in central bank interest rates, then you need to be able to recover. You need to be ready to provide some money into that. So you need to hedge things ultimately. Okay, fine, all right. So 2022 kind of came along, and this is when things started going a bit strange. So 2022 was a bad year for Silicon Valley Bank from many perspectives. First of all, their clients were startups and venture capital backed companies. And these young companies were often pre-revenue or still loss-making before they start making revenues. And this means that they either need to continuously raise more funds, alternatively, they need to burn through cash that they had. However, 2022 was a year when fundraising for startups and VCs was incredibly difficult. So consequently, these startups and venture capital backed companies, they burned through cash. And this meant that the total deposits held within Silicon Valley Bank went down during 2022. So that's a piece of negative news. The next piece of negative news was that indeed central bank interest rates did go up. And you can see it in August 2022 at the top right of this slide, that the CEO, Greg Becker, is trying to calm the markets. He's trying to tell the markets that everything is fine, we don't need to worry about anything, and so forth. But that's not true. Mr. Becker made those statements in August 2022, but in April 2022, he fired the chief risk officer at Silicon Valley Bank, left the company. And the new chief risk officer only joined in January 2023. So there was a long period between April 2022 and January 2023 when Silicon Valley Bank did not have a chief risk officer. Now, this is a key appointee during tough times. And Silicon Valley Bank had its money in long-term, long-duration bonds and securities, and they were hoping that they'd be able to sit on those long enough and ultimately crystallize them and then pay off and so forth to pay back their loans, make some money. It didn't work. It just didn't work. Weakening profitability in the tech world hit them, and the increased interest rates hit them. What they did while they had no chief risk officer was quite brutal. They chose to start selling the securities that they had against higher rates of interest. So the very safeguards that they had in order to protect themselves from high interest rates are things they sold. And they sold this in order to boost off short-term profits so that everything would look great. No, not so smart, because you have those things for a reason. Okay, so what happened next? Well, we come into the 8th of March, 2023. And now we have 3 dramatic days, really dramatic days. On Wednesday, the 8th of March, 2023, Silicon Valley Bank waited until all the stock markets had closed. And then after the stock markets had closed, so post-close, they made a statement saying that they want to raise $2.5 billion via sale of common equity. Now, there's a regulatory requirement at that point, on them at that point to disclose what their total situation is, which meant that they had to disclose that they lost $1.8 billion when they sold almost all their assets for sales, the AFSs. So they had to disclose that they had no protection against interest rates going high. Big negative signals out into the marketplace. And on Thursday, the 9th of March, the markets had its opportunity to respond. And the share price went down by 60%. Now, this is for a big company. Share price down 60% in one day. And a number of venture capital companies like Canaan, like Coatue, Union Square Ventures, Founders Fund, suggested to the companies that they've invested in and to their investors that they should perhaps pull funds from Silicon Valley Bank. These are incredible things. And at this point, you get cyber hurts, you get looking for soft prey. You immediately see people moving quickly, shorting, taking money out. looks very much like the South Sea bubble in London in 1720, very much the same behavior. In London in 1720, people were running around the streets trying to sell their shares. The 9th of March, that Thursday, was very similar for SVB shareholders. They were just trying to get rid of everything they had. And it went badly. Silicon Valley Bank clients used apps to literally swipe out $42 billion in one day from the bank. I mean, just imagine that. People with their cell phones, and they're swiping out $42 billion. These are incredible numbers to swipe out. Absolutely mind-boggling numbers to swipe out. And they did. And the consequences were that on the 10th of March, on the Friday, things went even worse. CEO Greg Becker, who is a very nice guy in the way he expresses himself, asked, please guys, just hang around, give us a chance. But there was a bank run. People just took out their money. There was nothing left. And the bank had obligations to make payments, and the bank was not able to make those payments. The share price dropped by a further 69%. Total collapse going on very, very quickly. The bank did have lots of assets in the form of long duration bonds, but they couldn't get the money out. So the bank lost its independence, the regulators moved in, and the rest is kind of history from there. Over the days afterwards, on Saturday the 11th, on Sunday the 12th, people started buying chunks of Silicon Valley Bank, and the bank was just split up, and that was that. So how did this happen? How is this at all possible? How can this possibly happen? And what are the thoughts we should carry with us when we think about this? Well, a number of things. First of all, we can see that there is a lot of money around and there is volatility. Now, if you're at the wrong end of that volatility, that's not much fun. But as a trader, having lots of money around, having lots of volatility around, that's what you want. That's a good thing. That gives you a reason to trade. And how should we think about banks? Well, first of all, banks are a symptom. They are not a cause. Banks are connected to everything else. Bank failures do come and go. The regulators, I think, are doing a great job, but the reality is that no one in the world knows how to do these quantitative tightening things. So there will be some casualties, and that's what we're seeing. It's very difficult. And when banks fail, they're not treated the same as other things. Secondly, when we think about these risks, we have seen risks before. Typically, when people consider risks, they assume that the next risks are going to be the same as the last risk. Well, that's not true. The thing that's characteristic about the risk is that it's something that's unexpected. Most typically, risks are unexpected. So if it was unexpected before, it'll be unexpected in the future as well. These things will happen again. And the biggest things we need to look out for are where we start making assumptions, such as house prices will always increase, because safe assumptions can be the most dangerous things. These are herd mentalities, and things can swing left, swing right. We don't know. Then we have industry tribal behaviors. And these can deviate from consumer trends. So I have a slide about that in just a moment. So I'll go back to that in just a moment. But if you look at Silicon Valley Bank, their ability to summarize their assets was not in real time. However, their clients did operate in real time. And the regulators typically have not operated on a 24/7 basis, whereas these customers and markets do operate on a 24/7 basis. So when you have tribes behaving out of sync with each other, out of sync with consumers, you have reason to believe that there can be risks in the future. And when banks fail, typically we see government step in and help out. The way that should work is that, well, it doesn't matter. The fact is that banks do get helped in most situations. So banks don't fail in the normal sense. And finally, we should be ready for new quantitative easing based chain reactions. The market is distorted. There's too much money out there. And people are trying to pull that money back. They don't know how. So we have a weird situation. We have a distorted market right now. Silicon Valley Bank is a symptom of these things. It's not a cause of these things. Credit Suisse is a symptom too, in a different way, of these things. So let's just summarize. Is there money and is there volatility in 2023, 2024? Well, yes, there is. And there's some crazy stuff going on right now, which I'd like to pull out as an example for volatility. And this is something I find really extraordinary. So the big celebrity companies that provide celebrities for the purpose of endorsement are now renting out their celebrities also in order to push assets in different ways. I play tennis. Often and badly. One of the people who's been pushing assets is a wonderful tennis player called Naomi Osaka. I would love it if Naomi Osaka would help me with my forehand, with my backhand. I'd absolutely love it if that were the case. However, respectfully, I don't want Naomi Osaka to give me financial advice. And we see that. So these celebrities, Gisele Bündchen, supermodel, she's famous for looking good, not for talking. So, but now they're giving financial advice. This is extra. I love these people, but I don't want to take financial advice from them because I have other people to do those things. So those are big things that started in 2022 and will accelerate, I think, in 2023, 2024. We have a new level of volatility coming from celebrities. This is a new trend. So more volatility. Well, how about money? Is there going to be more money as well? Well, yes. And one of the reasons that there's going to be more money is because of President Biden. So President Biden has committed $1.2 trillion to the Infrastructure Act, with which to build roads and bridges and things like that. That's so much money that it affects every country in the world because they will need to buy machines from every country in the world in order to make that happen. So that's an incredible sum of money. Additionally, President Biden is committing enormous amounts of money to the CHIPS Act, semiconductors, batteries manufacturing, and so forth. Again, enormous amounts of money going out, and it'll benefit many companies. Taiwan Semiconductor, Fujitsu's chip placement machines. Many companies will benefit from this. Again, big money going on. And on top of that, and you may find this slightly ironic, on top of that, $400 billion is being put in to fight inflation. Now, you may feel that if you add 400 billion to fight inflation, then will inflation really go down if you're printing more money because the output is not going up? Remember Milton Friedman in the beginning? Well, I think in summary, from our perspective as traders, the big summary is that there is money. There is money in 2023. That's what we are likely to see. The central banks do not know how to take the money back. They are the most clever people on the planet for doing that, and it's difficult, to put it mildly. The banks are fragile in between. Investment is fragile on the other side. It's very difficult to do quantitative tightening. No one's done it before. It's very, very difficult. And we have new stimuli coming in from different areas. China is opening up. China is going to be coming out into the global marketplace in new ways. The big summary is that there is money in 2023 and there is volatility. So this is probably the best time ever to be a trader. 2023, 2024 are probably the best times ever to be a trader. So if you don't already have an account with us, please do just get a standard account. If you're a bit professional, maybe an ECN account. If you're new to trading, try a cent account. If you just want to try things a little bit, you can simply register with your email and that gives you a demo account. But I warmly recommend that you go through the proof of identity, proof of address stages so that you can actually become a real trader. Again, use an ECN account if you're a bit professional, standard STP if you're a normal trader, cent account if you're new, but I warmly recommend that you go in that direction. And if you're building a business on top of Star Trader, well, we have introducing brokers, IBs, we have sub-IBs, we have big affiliate programs. A lot of people are running money management schemes through our systems, using our systems. These are really nice. We have copy trade, we have PAM, NAM, we have all of these different tools. And depending on what your goal is, we will customize things for you. I'm using the English word bespoke here for customizing things for your business. In America, we would use the word custom instead of bespoke. Both words are the same. The point is that whether you're a trader or whether you are a business who wants to use Star Trader as the basis for your business, in both cases, start out from where you are, work out where you want to go, what's your goal, talk to your dedicated account manager about how to create that journey for yourself, and do it. Let's execute that plan. Let's make it happen. There is scope to do some good business. So join us now. That's my big message. And the reason I feel that you should join us now, as I've said before, is because of all of these things we've just gone through. There is money in the market. There is volatility in the market. Forex is growing. Gold trading is growing. Forex, all the assets, everything is growing. All of these areas of business are growing. It's fun. It's exciting to be a trader. And I know that Silicon Valley is a symptom of some very difficult underlying problems in the market. And those underlying problems are that central banks don't know how to take the money out. But from a trader's perspective, that's not a bad thing. And if there's a lot of money going around and if there's a lot of volatility, then the answer to the question about is there money is yes, there is money. So thank you, everyone. And I look forward to seeing you on the global markets. Thank you.